when you think about the state of private equity and the idea that so much of what it does has been thematic investing, sort of following where the puck is going, those sort of moonshots here, how much has AI either helped or hindered the state of the private equity industry?
Well, I think what AI has done is certainly give a hockey stick effect to a number of businesses who, if they develop AI products, it can be a great inflection point in valuation. Now, traditional private equity buyouts, as you both know, only tackles sort of profitable, steady-state businesses. It's the game of venture and growth capital to really fund those moonshots. So while AI has been a great story for the markets in general and is a great promised land for many businesses, the reality of what actually exists in the state of the art in many businesses who are making AI plays, that's a story that's yet to be told.
One of the big issues in the private equity space, whether it's really ailed it, has been, of course, the big rise that we saw in interest rates, which now may actually come down, but also the whole issue, too, that some of the returns that were promised in the most recent vintages, at least for right now, haven't panned out. Are we maybe at a point where that is going to start to pan out, that these issues will be resolved?
I think there's a whole slew of the market, most importantly the limited partners that fund private markets, that are waiting for a change in the interest rate cycle to drive an M&A boom and therefore drive a return of capital boom to them. It has been slower than anyone expected. Last year was one of the lowest years for return of capital in the last 15 years, and so far year to date is the second lowest. Just goes to show that limited partners, the endowments, foundations, pension plans that fund private markets are saying that unless you get me return on capital back, I'm not likely to re-up at the same level as I was in the past. Now, this will resolve over time, and the interest rate pivot will certainly help, but it's been a struggle over the last 18 months, no question.
I think about what Scott Kleiman, the co-president of Apollo, said not so long ago in June. He was saying that I'm here to tell you not everything is going to be okay. There are going to be fewer realization and lower returns on the horizon for much of the industry. How much of that have we already seen? How much of that is still to come?
I think in terms of the realization part, he's absolutely right. It's been a very tough 6 quarters or so. Now, private equity runs on a clock. It's a 4 to 5 year investment cycle followed by a 4 to 5 year harvest period or exit period. We've run up against the back end of that, and the industry is now facing companies that they've held on to for 6, 7, now 8 years. I think the big risk is that of an aged assets problem, but with that clock also comes an impetus that everybody has to do something and do something soon, otherwise they're going to run out of that time clock. And so we have this pressure building where that's that interest rate pivot plus the elections that everyone wants to get past before the private equity sponsors really come to market to sell their businesses. And I think that we're going into a tick-up. We've been seeing the tick-up for the last 2-3 quarters, but that inflection point will really happen after the Fed starts cutting rates.
Okay, after the Fed starts cutting rates, how soon after the Fed starts cutting rates?
Well, if the Fed starts cutting rates and we get past the election and the elections kind of settle in, they're priced into the markets in terms of valuations, you're looking at about a quarter to 2 quarters thereafter. It takes about a quarter to sell a business.